Chinese-style value delivery, interpreting the world's top books. Hi, this is Sally from Book Talk. Today we're breaking down Irrational Exuberance. In everyday life, lots of folks invest in stocks, and you often see crazy swings, huge jumps, and sudden crashes. Take the 2008 financial crisis. Stocks shot up just before it, then crashed down hard, tanking financial markets and the real economy, wiping out tons of wealth. If we figure out why asset prices swing and what affects them, it's like unlocking the secret to investment riches. This is also a big deal in academic research. Traditional finance treats the efficient market hypothesis as a key foundation, starting from the rational person idea, meaning investors are rational folks who always weigh risks and gains logically. Investors do fundamental analysis. They rely on facts and figures, not emotions or trends. So, the stock market mirrors what all rational thinkers believe. Markets are efficient. No bubbles here. Stocks get priced right, showing all the info out there. But since info's unpredictable, so are stock prices. That's the random walk. Building on that, classic theory says stock markets have no mispricings. Price swings are totally random and can't be predicted. But in the 1980s, research popped up challenging the rational idea. They found market quirks like the January effect, Monday effect, and small cap effect. For instance, the January effect means stocks tend to do better in January than other months. If markets were efficient and prices totally random, we wouldn't see these patterns. Predicting the best month should be impossible. Facing these things that old-school finance can't explain, some academics doubt the rational person idea. They say investors are only partly rational, swayed by mental flaws, and that messes with the whole market. We've got to look beyond the old ways, dive into human minds, psychology, thinking, feelings, to find new drivers of asset prices. These scholars absorbed findings from psychology, behavioral science, sociology, and other fields, forming a new major academic school. That is, behavioral finance. For instance, regarding the January effect mentioned earlier, behavioral finance suggests reasons like people selling stocks in December to save on taxes and buying back in January, plus investing year-end bonuses around January. The author of the book we're discussing today, Robert Shiller, is one of the main founders of behavioral finance. And he is a renowned American economist and professor in the economics department at Yale University. In 2013, he won the Nobel Prize in economics, along with Eugene Fama and Lars Peter Hansen, for his contributions to empirical analysis of asset prices. Besides this book, his major works include Animal Spirits, Finance, and the New Financial Order. The title of this book is Irrational Exuberance. This concept was actually used by financiers over a century ago, but it wasn't until 1996 that it gained widespread attention. Then Fed Chairman Alan Greenspan used irrational exuberance in a speech to describe the state of investors in the stock market at that time.
The market interpreted this as the Fed believing the market was in a bubble and would take measures to cool it down.
Global stock markets fell in response, and from then on, irrational exuberance entered the public consciousness, becoming a buzzword. This book was first published in 2000, when the stock market was rising steadily and market optimism was high. But the author stated in the book that the U.S. stock market was at a peak of irrational exuberance and might soon see a downturn. Shortly after, the dot-com bubble burst. The Nasdaq index fell nearly 80% over the next 2+ years. In the second edition published in 2005, the author added content on the real estate bubble. And once again, his prediction came true. A little over a year later, the subprime mortgage crisis erupted, triggered by the bursting of the real estate bubble. Thanks to this prophetic insight and its sophisticated, unique framework of thought and reasoning, the book enjoys a high reputation internationally. The New York Times commented that Mr. Shiller is like a prophet who understands Wall Street, and his theories provide a timely and rational explanation for the growing unease in the stock market. Next, I'll break down the causes of irrational exuberance into three parts for you: structural factors, cultural factors, and psychological factors. Since the stock market is a key focus of this book and one of the most familiar investments for us ordinary investors, so my next explanation will mainly cover the stock market. Let's start by getting an intuitive feel for irrational exuberance. The author examined the historical trends of the S&P 500 index from January 1871 to June 2114. Over nearly 150 years, the U.S. stock market has experienced five major booms. The first was from 1920 to 1929, where the S&P index grew 5.2 times compared to 1920. The second was post-World War II, from 1949 to 1968, with the stock market boom growing 5.7 times.
The fourth was from 1982 to 2000, the wildest surge ever, dubbed the millennial boom, with stocks up 7.7 times.
The fourth was from 2003 to 2007, with stock growth of 1.5 times, ending in a global financial crisis.
The fifth was from 2009 to 2014, post-financial crisis, with the stock boom growing 2.3 times.
The author notes that some stock market booms are based on economic growth and rising corporate profits. But others aren't. Like between 1994 and 2000, when US GDP grew less than 40% and corporate profits under 60%.
Yet during that same time, the S&P index jumped from over 400 points to over 1,300 points.
Clearly, such massive gains can't be explained by macroeconomics or business growth. The author calls it unfounded. This rapid stock growth that defies fundamental explanations is what we call irrational exuberance. The author categorizes the causes of irrational exuberance into structural factors, cultural factors, and psychological factors. First, let's cover part one: structural factors informing irrational exuberance, which boils down to two stages: precipitating factors plus amplification mechanisms. Using the millennial boom from 1982 to 2000 as an example, the author explains precipitating factors, like political triggers, as the initial causes of stock rises. In 1980, after Ronald Reagan was elected U.S. president, pro-business Republicans gained more political power. The public believed the government would take stronger actions to boost corporate profits and protect investors. This expectation indeed came true. For example, in 1997, the maximum capital gains tax rate was slashed from 28% to 20%, greatly boosting investor confidence. And fit. Next are economic triggers. Ways for people to invest in stocks have multiplied, notably with the growth of pensions and mutual funds, providing a steady stream of capital to the market. And furthermore, there are cultural triggers. The public believes that the post-War I-II baby boom had a positive effect on the stock market because this generation lacked the scary memories of economic depression, making them more confident in investing.
All these are precipitating factors for the millennial boom. They caused the initial stock price rise, but to reach the euphoric state of irrational exuberance, the second half of structural factors is needed.
The author calls this an amplification mechanism, operating through feedback loops. Feedback loops mean that past price increases boost investor confidence and expectations.
These investors further drive up stock prices. The wealth illusion from high prices attracts even more investors, creating a cycle that continues, ultimately leading to an overreaction to the original triggers.
The author uses the Ponzi scheme as an analogy for this process. The inventor of the Ponzi scheme was Charles Ponzi. In 1919, Ponzi claimed that investors would get up to 40% profit within 3 months. But in reality, Ponzi wasn't investing. He was just paying new investors' money to old investors. Seeing real returns, more and more investors were drawn in, and the scam lasted over a year. Later, People called this model using new investors' money to pay interest to old investors, creating a false profit illusion to lure more investment, a Ponzi scheme. The author argues that the stock market's amplification effect resembles a Ponzi scheme. Rising stock prices, like the wealth stories of old investors in the scam, boost confidence among existing investors and attract wave after wave of new ones. Sustained surges depend on a continuous influx of new investors. The end result is a naturally formed Ponzi scheme, i.e., the irrational exuberance bubble. Now that we've understood the formation process of irrational exuberance, let's look at the specific causes behind it. The first specific cause is cultural factors, mainly New Era thinking and news media. What is New Era thinking? It refers to the mindset where people infer the future must be better than the past based on certain phenomena. For example, in the early 20th century, behind the stock surge were high-tech innovations like transoceanic radio transmission, early fax machines, and simulated moon travel. And Americans believed the high-tech era, computer age, and space age were right around the corner. Another example, behind the 1920s boom were post-WY innovations like widespread electrification, with lights, vacuum cleaners, and washing machines entering homes, transforming daily life. People believed they were facing a brand new world of technological revolution. In the 1950s to 60s, the surge came from optimism around Kennedy's economic plans and anticipation of the Dow breaking 1,000 points. Behind the 1990s surge was confidence in internet development, among other factors. But looking back, while each era's excitement differed, they shared one thing. People's fervently believed new eras weren't actually that special or transformative enough to propel the economy or stocks into a genuine new age. For instance, in the 50s to 60s, the Dow nearing 1,000 was seen as a milestone symbolizing prosperity, sparking massive public anticipation. This view might sound a bit ridiculous at first, but the author's study of historical news shows society was indeed swept up in optimism, forming a key basis for that stock boom. Yet rationally, an index crossing an arbitrary number means little, especially since that milestone didn't happen for over 2 more decades. Similarly, the early 1900s space-age thinking, 1920s electric era ideas, and 1990s internet era beliefs we mentioned earlier. Undeniably, there were great technological advances at those times. But looking back today, we see those technologies were still in early stages, with their true potential far from realized. Moreover, it's hard to prove whether new technologies like high tech and the internet boost the economy more than earlier innovations like railways, telephones, and cars. People often overestimate how productivity advances affect the economy and stock market. But why do these consensus ideas form? The author thinks it might just be hype from news media and public figures. Through overwhelming coverage, books, and public statements, new era thinking consensus forms, fueling widespread investor optimism and driving irrational exuberance. So next, we'll dive into cultural factors. Second point, news media. The author believes news media affects stocks by steering public attention. People focus more on reported positives or negatives, developing corresponding market optimism or pessimism. News media. The book gives the example of the Kobe earthquake in Japan. In 1995, a 7.2 magnitude earthquake hit Kobe. That day, Japanese stocks only dipped slightly.
Yet 10 days later, with no new bad news, the Nikkei index suddenly plunged 5.6%.
Why did financial markets react so late? And so violently? The author argues that, right after the quake, investors were relatively rational, but post-earthquake news reports kept stressing huge economic losses and discussing other possible disasters. The author uses the millennial boom, 1982 to 2000, to illustrate precipitating factors, initial stock triggers, starting with political ones. In 1980, after Ronald Reagan became U.S. president, pro-business Republicans gained power. The public believed government would boost profits, and protect investors. This expectation did come true.
For example, in 1997, the top capital gains tax rate was slashed from 28% to 20%, greatly boosting investor confidence.
Next are economic triggers. Investment avenues multiplied, especially through growing pensions and mutual funds, providing steady market capital. Furthermore, there are cultural triggers. The public believes that the post-WHO baby boom has a positive effect on the stock market because this generation doesn't have the scary memories of economic depression, making them more confident in investing. All these are precipitating factors for the millennial boom. They caused the initial stock price rise, but to reach the euphoric state of irrational exuberance, the second half of structural factors is needed. Oh. The author calls this an amplification mechanism operating through feedback loops. Feedback loops mean that past price increases boost investor confidence and expectations. These investors further drive up stock prices. The wealth illusion from high prices attracts even more investors, creating a cycle that continues, ultimately leading to an overreaction to the original triggers. The author uses the Ponzi scheme as an analogy for this process. The inventor of the Ponzi scheme was Charles Ponzi. In 1919, Ponzi claimed that investors would get up to 40% profit within 3 months. But in reality, Ponzi wasn't investing. He was just paying new investors money to old investors. Seeing real returns, more and more investors were drawn in, and the scam lasted over a year. Later, people called this model using new investors' money to pay interest to old investors, creating a false profit illusion to lure more investment, a Ponzi scheme. The author argues that the stock market's amplification effect resembles a Ponzi scheme. Rising stock prices, like the wealth stories of old investors in the scam, boost confidence among existing investors and attract wave after wave of new ones. Sustained surges depend on a continuous influx of new investors. The end result is a naturally formed Ponzi scheme, i.e., the irrational exuberance bubble. Now that we've understood the formation process of irrational exuberance, let's look at the specific causes behind it. And the first specific cause is cultural factors, mainly new era thinking and news media. What is new era thinking? It refers to the mindset where people infer the future must be better than the past based on certain phenomena. For example, in the early 20th century, behind the stock surge were high-tech innovations like transoceanic radio transmission, early fax machines, and simulated moon travel. Americans believed the high-tech era, computer age, and space age were right around the corner. Another example, behind the 1920s boom, were post-WWEN innovations like widespread electrification, with lights, vacuum cleaners, and washing machines entering homes, transforming daily life. People believed they were facing a brand new world of technological revolution. In the 1950s to 60s, the stock surge stemmed from optimism about Kennedy's economic plans and excitement over the Dow nearing 1,000 points. Behind the 1990s surge was confidence in internet development and such. But looking back, while each era's excitement differed, they shared one thing. People fervently believed new eras weren't actually that special or transformative enough to propel the economy or stocks into a genuine new age. For example, in the 50s to 60s, the Dow approaching 1,000 was seen as a milestone symbolizing prosperity, sparking massive public anticipation. This view might sound a bit ridiculous at first, but the author's study of historical news shows society was indeed swept up in optimism, forming a key basis for that stock boom. Yet rationally, an index crossing an arbitrary number means little, especially since that milestone didn't happen for over 2 more decades. Similarly, the early 1900s space age thinking, 1920s electric era ideas, and 1990s internet era beliefs we mentioned earlier. Undeniably, there were great technological advances at those times, but looking back today, we see those technologies were still in early stages, with their true potential far from realized. Moreover, it's hard to prove whether innovations like high tech and internet boost economies more than earlier breakthroughs like railways, phones, or cars. People often overestimate how productivity gains affect economies and stocks. But why do these consensus ideas form? The author suspects it's largely hype from news media and public figures. Through relentless coverage, books, and speeches, new era thinking consensus takes hold, fueling investor euphoria and irrational exuberance. So next, let's explore cultural factors in depth. Second point, news media. The author believes that news media affects the stock market by controlling public attention. People focus more on positive or negative factors reported and develop corresponding optimistic or pessimistic attitudes towards stocks. The book cites the example of the Great Hanshin earthquake in Japan. In 1995, a magnitude 7.2 earthquake struck Kobe, Japan. On that day, Japanese stocks only declined slightly. However, 10 days after the earthquake, with no new negative events, the Nikkei index suddenly plunged 5.6%. Why did the financial markets react so slowly?
But so violently?
The author argues that immediately after the quake, investors were relatively rational. But after the quake, news reports kept emphasizing the huge economic losses and began discussing other possible disaster scenarios. For instance, accumulating news about the possibility of a major earthquake in Tokyo made people focus increasingly on potential negative impacts, creating pessimism that led to a sudden, inexplicable stock crash. Thus, contemporary media culture can sway people's judgments and shape consensus views on stock market prospects. When markets are down, it pushes investors toward greater pessimism. When markets rise, it fuels greater optimism, leading to irrational exuberance. Having covered cultural factors, new era thinking, and media culture, next, let's move to the third part, psychological factors. Focusing now on the more micro-individual level. From a psychological perspective, reasons for irrational exuberance include anchoring effects, overconfidence, and intuitive judgment, plus herd mentality. We'll start with the anchoring effect. Simply put, the anchoring effect is when people judge something unknown by using a known reference point as a standard to evaluate the unknown. The author categorizes stock market anchoring into quantitative anchors and moral anchors. Quantitative ones are easier to grasp.
Let's explain using the Wheel of Fortune experiment. The wheel has numbers 1 to 100. Researchers first spin it to land on a random number.
Participants see this result. Then researchers ask very difficult questions. For example, questions like, how many African countries are in the UN? Results showed that even though everyone knew the wheel's number was random and meaningless, their answers were heavily influenced by it.
If the wheel landed on 10, participants' averaged answers around 25. If it landed on 65, the average jumped to 45.
This shows people tend to use the most accessible number as a reference benchmark. In stocks, this quantitative anchor exists too. It's the level people think the market should be at. They use it to gauge if stocks are over or undervalued, guiding buy or sell decisions. In the stock market, the easiest references are historical prices and trends.
If stock prices keep rising, investors form a simple collective belief they'll keep climbing.
Few believe they'll be left holding the bag in this game of hot potato, so prices get pushed higher, fueling irrational exuberance. The second psychological anchor is the moral anchor, essentially a trade-off deciding what percentage of wealth to put in stocks. This concept is more abstract. The book gives an extreme example. If stocks surge and many investors become paper millionaires, would they keep holding shares or sell to live richly? For most, unless they have unshakable faith in stocks, they'd cash out and reduce their stock exposure.
If this choice becomes consensus, it triggers massive sell-offs and rapid market declines.
The author concludes that stocks only reach higher levels when people see strong reasons not to spend newfound wealth. Clearly, moral anchors directly affect stocks too. But what influences and determines these moral anchors? The author tells us influencing moral anchors is simple. Just a compelling story suffices. Behind this phenomenon lies a universal psychological basis. People love finding simple, direct reasons for decisions. Psychologists conducted an experiment proving this effect exists. In the experiment, researchers presented two options describing different traits of a child's guardian. Option 1, average income, average health, moderate working hours, good with children, stable social life. Option 2, above average income, fewer health issues. Frequent business trips allow for a very harmonious relationship with children and a very active social life. As you can see, option 2 has more detailed characteristics, with both strengths and weaknesses being prominent. Researchers divided participants into two groups, asking them to face the same options but answer opposite questions. Which guardian you'd be willing to entrust your child to, and which you wouldn't. Interestingly, despite the opposite questions, they got consistent answers. In both groups, the majority chose option 2, which has more vividly depicted characteristics. It shows that in this experiment, participants didn't rigorously analyze which is better for childcare, whether it's wealthy people, but busy people are more advantageous, or those with average income, or those with stable lives are more advantageous. If based on such rigorous analysis, the answers chosen by the two groups should have been opposite. But the fact is, regardless of the question, people always tend to choose the option with more information that allows for philo-reasoning. So, back to the stock market, you can understand the following phenomenon. In 1996, there were many similar bestsellers in the US, like one called The Millionaire Next Door. And this book claims that most American millionaires didn't get rich through labor but by investing. They don't spend money on new cars, houses, or other consumer goods, but save their income, invest in stocks, and achieve life turnarounds through stock investments. Does this pattern sound a bit familiar? We often see similar stories nowadays, but if you analyze calmly, you'll find there's no serious research or proof in them. They usually don't detail the protagonist's life backgrounds. Nor do they cover investment skills like how to do macroeconomic analysis or pick a good stock. They just tell some stories, true or false. But these stories are often detailed and vivid, easily influencing readers, making them unconsciously believe the wealth stories in the book, see the protagonists as role models to emulate, and thus use money for investment instead of consumption. It's easy to imagine that if this kind of information floods everywhere, it could form a consensus that investing beats spending. This phenomenon provides essential momentum for sustaining irrational exuberance. In short, people use quantitative anchors to gauge reasonable stock levels and moral anchors to allocate wealth between investments and other uses. Anchoring effects deeply influence market ups and downs. The second psychological factor is overconfidence and intuitive judgment. That is, people think they know more than they actually do, and they don't think based on logic, they rely solely on intuition. For example, after the 1987 stock market crash, the author conducted a survey asking, "Do you know when the market will rebound?" Results showed nearly half of investors who bought during the crash said yes. Even among non-traders, 30% said yes. The follow-up, "Why think you know when?" revealed almost everyone cited intuitive reasons. This shows that while markets are objectively unpredictable, especially on chaotic crash days, many investors still make intuitive judgments and firmly believe them. With this intuitive bias plus human overconfidence, investors easily form consensus in similar information environments. The third factor is herd behavior. People's judgments and decisions are easily swayed by others. Let's examine a psychology experiment. In the experiment, psychologists showed participants two cards. The first card had a single line segment. The second card had multiple lines of varying lengths. Participants were asked which line on the second card matches the first card's line length. Though simple to answer correctly, when actors deliberately gave wrong answers, up to 1/3 of participants copied the error. Even with simple problems, we can't escape herd effects misleading poll. Imagine then, with complex market info, even insignificant news can trigger herd resonance, sparking irrational exuberance. For example, when a certain technology or model suddenly goes viral, people tend to blindly follow others without research, flocking to hype up hot concept stocks, driving prices sky high and creating bubbles in a sector or specific stock. Oh. Eventually, people realize the concept isn't as promising as imagined, and they flee, leaving a mess behind. This scenario plays out repeatedly in stock markets. You might ask, when observing an individual's behavior, following others seems like a safe, rational choice. But how do such individual choices evolve into irrational herd behavior? The author explains it through information cascade theory. To illustrate information cascade theory, we can use an example. Suppose two adjacent restaurants open. The first customer sees both empty places, then chooses based on some information they have. When the second customer chooses, they see not two empty restaurants, but one with customers, and the other empty. Based on life experience, the second customer will likely follow the first's choice. For subsequent customers, similarly, eventually, all potential customers may choose the same restaurant. This is an example of herd behavior. Clearly, the outcome is irrational. If the first person had poor judgment, everyone ends up choosing the worst restaurant. Information cascades describe this phenomenon. When people see predecessors' choices but not their reasoning or information, they abandon their own preferences and blindly follow. It's called a cascade because the impact intensifies downstream, like a waterfall's force. In information cascades, the further down the chain, the stronger the effect. Information cascade theory effectively explains investors' flawed decisions in stock markets. In stock market cascades, information gets distorted. When a stock's price rises, latecomers assume early buyers must have bullish information, so they substitute others' decisions for their own, buying in and driving prices even higher. But in reality, positive news might not exist at all, yet the irrational exuberance bubble has already been inflated. To briefly summarize, irrational exuberance has two stages: precipitating factors plus amplification mechanisms. Some triggers cause the initial stock price rise, then amplification drives sustained increases, forming irrational exuberance. Specifically, cultural and psychological factors heavily influence this. People overreact to new era thinking, mistakenly believing the present is uniquely prosperous. Meanwhile, advanced media culture makes attention cascade effects easier to trigger, amplifying existing trends.
Psychologically, investors exhibit anchoring effects, overconfidence, intuitive judgments, and herd behavior, all leading to irrational actions.
These factors collectively fuel irrational exuberance. All right, now that we understand how irrational exuberance forms, let's explore effective countermeasures. The author believes ordinary people can mitigate negative impacts through preparation and diversification. So, both are essentially about life risk management. Preparation means, when planning savings and retirement, always account for potential bubbles. Historically, U.S. savings rates plummet during stock booms. Both individuals and institutions pour money into markets, suffering heavily when bubbles burst. He advises investors, don't get complacent from past successes. Remember, booms and high returns won't last. Always save and manage risk. Another key is diversification. This concept is often limited to stocks, buying low correlation shares.
But the author argues diversification should apply holistically to life. Identify your biggest risks.
Like job loss or falling home prices, then hedge by holding assets negatively correlated to your income, achieving comprehensive life risk management. Simultaneously, reduce dependence on single investments like stocks or real estate. But achieving this requires governments to improve financial systems and create diverse instruments for ordinary investors. All right, that covers the main points of irrational exuberance. In this book, the author provides an analytical perspective distinct from traditional finance's rational person assumption. SC 1 for irrational market fluctuations that traditional theories can't explain. He establishes a robust research framework, diagnosing the structural, cultural, and psychological roots of crises from the psychological and behavioral angles of market participants, dissecting the deep causes behind stock market volatility. This book not only has strong theoretical value, encompassing the author's key research in behavioral finance, but also outstanding practical value. We can try applying the book's theories to daily life and investments, like being more cautious and critical toward financial reports and bestsellers, thinking independently about the essence and true impact of events or trends, and staying more vigilant. When making investment decisions, ask yourself, am I influenced by anchoring effects, overconfidence, intuitive judgments, or herd behavior? Do these cognitive weaknesses affect the basis for my decisions? Can they withstand careful scrutiny? Warren Buffett said, be fearful when others are greedy, and greedy when others are fearful. Understanding human nature and overcoming its weaknesses is an unavoidable test for stock market participants. There's nothing new under the sun. Even as the world evolves, technology advances, and environments change, the market's ups and downs are always driven by complex, eternal human nature gains. If we can gain some insight, it can help us navigate the market's tides more safely and smoothly. All right, that's the interpretation of irrational exuberance for you. The reading notes are below the audio. See you next time.